think the key point is that weak growth and low inflation mean policy rates are going to remain low, and core government bond yields will remain also over the next 5 years. In equity markets, the key thing to remember is that we're expecting the level of GDP never quite to get back to the pre-crisis path, which means that ultimately stock market earnings shouldn't either. And in that context, and with rising yields, it seems like the outlook for returns is quite challenging.
The demand for secondary market liquidity is likely only to increase. Usually during periods of market stress, there's a general lack of liquidity and investors sometimes experiencing financial distress.
Mm-hmm.
Also, what you have in these dynamic market conditions is investors likely to execute strategic positioning to certain sectors or rebalancing asset classes or geographies to achieve their investment goals. And we expect more investors increasingly to look for these options as they recognize that this lack of liquidity can sometimes transform into a risk rather than a liquidity performance premium. First, while the business case for leveraging alternative assets is compelling, managing private portfolios requires significant resources. And those resources are typically available more to the larger financial institutions. Smaller firms and individual investors tend to be constrained to pick top managers and reallocate their portfolios. Also, the process of investing in alternatives for small investors is complicated by the limited liquidity in the secondary market for smaller deals. So we think that this space where Beneficient operates, offering liquidity more rapidly and efficiently for smaller deals, is likely to grow substantially, both in terms of volume and industry focus.